Ever pondered the art of evaluating a company's financial health? It might seem like a daunting task at first, but armed with the right tools, it becomes a fascinating journey into the heart of a business. Today, we'll be exploring the world of financial ratios, powerful indicators that can provide insights into a company's performance, profitability, and risk profile. First up is the price-to-earnings ratio, or PE ratio. This measures the price of a company's stock relative to its earnings per share. Think of it as a gauge of market expectations. A high PE ratio might suggest that the stock is overvalued, while a low PE ratio could hint at undervaluation. But remember, a high PE ratio can also indicate the market's expectation of high growth in the future. Earnings per share, or EPS, is another vital metric. It represents the portion of a company's profit allocated to each outstanding share of common stock. A higher EPS signals higher profitability, making it a key player in the investment decision-making process. Next, we have the return on equity ratio, or ROE ratio. This showcases how much profit a company generates with the money shareholders have invested. A higher ROE is generally a good sign, as it indicates effective use of equity. Moving on to the reserves to debt ratio. This ratio calculates the proportion of a company's reserves to its total debt. Higher ratios suggest a stronger ability to cover debt obligations from internal funds, providing a safety net in times of financial turbulence. The interest-to-profit ratio is another important indicator. It shows the proportion of a company's operating profit that goes towards paying interest expenses. A lower ratio is preferable as it reflects the company's ability to comfortably cover its interest expenses from operating income. Now, let's not forget about some other commonly used ratios. The current ratio measures a company's ability to cover its short-term liabilities with its short-term assets. The debt-to-equity ratio evaluates a company's financial leverage by comparing its total debt to shareholders' equity. The gross profit margin indicates the percentage of revenue that exceeds the cost of goods sold. The inventory turnover ratio measures how many times a company's inventory is sold and replaced over a period. Lastly, the accounts receivable turnover ratio shows how efficiently a company collects its receivables from customers. The secret to using these ratios lies in comparing them to industry benchmarks, historical data, and competitors. This comparison helps assess the company's performance, financial health, and efficiency. For instance, a higher current ratio indicates better liquidity, while a lower debt-to-equity ratio suggests lower financial risk. Remember, it's crucial to analyze these ratios in conjunction with other financial metrics and consider the broader economic and industry context. So, the next time you're evaluating a company's financial health, these ratios will be your trusty compass, guiding you through the world of financial statements. Happy exploring!